Okay, yeah, well then, welcome everyone. I'm happy that you're here, and I'm looking forward to present and talk about the one of my favorite topics, which is Bitcoin, blockchain, and cryptocurrencies. And I would usually like to add disruption and progress because it's really crazy what is going on. And yeah, I hope you find it insightful to get the basis of it. So today's content will be, first of all, we will explore what is Bitcoin on a technical and on a non-technical level. So you get a really high-level understanding of how it works and what the use of it is, aside from a speculative tool, of course. Then we will talk explicitly about Bitcoin mining. This is a very important part of Bitcoin, a very important aspect. And I feel like it's very important to go there a bit more into detail because there is still some misinformation spread around, and yeah, that's just not good. And then lastly, we will look into use cases for cryptocurrencies in general, because as you know, there are thousands of cryptocurrencies by now, and they don't really compete with Bitcoin because they have different use cases and they are very exciting and revolutionary as well. Okay, so if you would ask me, what is Bitcoin in one sentence, then maybe I would reply, Bitcoin is a decentralized open transaction ledger on an immutable blockchain with economic incentives baked into the protocol to create a network effect. And then you would maybe ask me, all right, so what? So let's dissect this a little bit. But these are basically the parts of a Bitcoin. So decentralized, that's pretty straightforward. You don't have any centralized entity like a central bank or a company that controls the Bitcoin network, but instead, it is decentralized all over the globe. It is open, and therefore it is often compared to the internet, because it is exactly like the internet. You don't need any permission to enter the network or to build on top of the network or use the network. So anyone can come and set up a so-called node to run the Bitcoin network, or you can just buy Bitcoin tokens, which are like the Bitcoin that you know, which is actually just a token on top of the Bitcoin network. So anyone can do that. No one can stop you from doing that. And so it's very, very open and equal. It is a transaction ledger, so that's what it is on the left side here, accounting ledger. So it's just a list of transactions, basically. And these transactions are recorded on an immutable blockchain. A blockchain is a data structure, so it's the way you save data, and it is immutable. And this is partly because it is decentralized. So you can also have centralized blockchains. These would be private blockchains, company-specific blockchains, but they are not necessarily immutable. So that's an important aspect here. Then the economic incentives that create the network effect of the protocol, we will come to that later in more detail. So let's get the more or less difficult part out of the way first. So technical part. What is a blockchain? How does a blockchain work? I try to break it down very simply so that you get a high-level understanding. So a blockchain, as the name should suggest, consists of blocks, and they are linked with each other. So they are kind of chained together. That's why it's called blockchain. And inside these data blocks, you have the transaction recordings. That's the basic principle. And so you put transaction into one of these blocks, and then you seal the block. And this is a mathematical operation called hashing. You use a certain function for that. And there are some different details, like how difficult it is to actually seal the block in terms of the mining, Bitcoin mining. We will not go into so much detail there, but the important thing to understand is that when you seal the block, it basically creates a fingerprint of this block. And this fingerprint will be included into the sealing of the next block. And so you can never change one of the past blocks without changing without changing all of the other blocks as well, because the fingerprint is part of the next fingerprint. You can understand it like you write a word and then you have to use to write the next word, like street, and then you say timber. Now, if you change the first word from street to pudding, then instead of a T, you would have a G as a last word. And so anyone who checks this chain could immediately see that you changed this one word. And because it doesn't fit together anymore with the next word. And this is exactly how a blockchain works. And now in terms of Bitcoin, the specialty is that like the whole network agrees on one version of the blockchain. So even if you on your computer change the blockchain, which you can do, it wouldn't help you, because the rest of the network would not accept your version of the Bitcoin blockchain, because you did not put in the computational work to actually redo all of these fingerprints. And that's quite complex. So I think as a higher level understanding, this should be really nice. And if you have any questions, then later on, we have time for that as well. All right, so, but what is Bitcoin from a non-technical standpoint? The easy part, it is basically digital money. And the interesting thing here is that it is sound money. So sound money means that the value of the money is determined by market forces, so by demand and supply. But because the supply is fixed and cannot be changed, it is a really good store of value as well, because you cannot be diluted away, right? Not like with our current monetary system, where central banks can just print as much money as they want. That's not possible with Bitcoin. So these characteristics make Bitcoin a suitable base for an alternative currency system, because the future is digital. That's like a given. But what we also see is that our current monetary system is not sustainable. It creates serious issues in society and in the economy as well. So we can build an alternative, and the principles of Bitcoin are definitely suitable for that. Now, if you hear that alternative currency system, then of course it would be nice to get a feeling for the proportions, what that would actually mean. And so I have a link here. When we provide the presentations, you can visit that link as well. I think I showed that also one time in the discussion round, where you have a visualization of different types of wealth, basically. So, for example, you will see the money supply in terms of value in US dollar globally, and how much real estate there is in stocks, etc. And then you have Bitcoin in comparison, and you will see that it's just so small. And that just means that we are at the very, very beginning still. All right. So if we go a bit deeper and explore what Bitcoin is, then it is the easiest to start with the opposite, what Bitcoin is actually not. And this here is a picture from Venezuela, where money literally lost all of its value, and it is lying around like rubbish, because no one cares. It is actually cheaper to wipe your backside with money than to buy a roll of toilet paper. So that's how ridiculous our today's money can get. And Bitcoin is definitely the opposite, because it simply cannot be inflated away. It's impossible. And that's one of the big strengths. So here you see it. Bitcoin is sound money. So in the upper picture, you see the monetary base of the United States dollar. And as you can see here in 2008, 9, it was increasing substantially because of the financial crisis. And then since then, even it increased continuously. And now recently, because of Corona, it again exploded. And this is expected to increase even more because of all the stimulus bills and the second lockdown that we're looking into, and the overall economic situation. Because people believe that you can just print money to solve problems, and that's just simply not true, because the printing of money is actually the cause of the problems. So that's the situation today. And then below that, you see total Bitcoin in circulation, and it starts basically at the same time frame, right? So it's very comparable. While the one thing is increasing aggressively, Bitcoin is actually flattening out, and that's exactly the point. Bitcoin has a kind of an inflation right now because we are at the Bitcoins in circulation are 18.5 million currently. And the maximum limit will be 21 million. But until then, there will still be Bitcoins issued by the network to the Bitcoin miners as a reward to secure the network. And this will basically reach 21 million Bitcoin in 2140, around that date. We have 88% of all Bitcoins in circulation already, and the rest will be spread over the next 120 years. So there's not much coming or adding on top of that. Again, you cannot be diluted. And the market determines the price or the value of the money. That's sound money. Store of value characteristics, also very important for money. Again, comparison US dollar versus Bitcoin. On the left side, that's the US dollar on a linear scale from the last 100 years, let's say. And well, as you can see, it's a very clear trend. Unfortunately, it's a linear scale. But if you would have a logarithmic scale, then you would see that the percentage decrease is actually like relatively linear. So it's constantly on a relative basis decreasing. The buying power is decreasing. While on the right side, you see the Bitcoin price since that's around 2010. So 1 year after inception, because in the beginning there was just no market and therefore there were no prices. It's very young. But this scale is actually a logarithmic scale. And I chose this scale because otherwise you would simply not see the price prior to 2017. It would basically be a flat line on a linear scale because it is increasing exponentially, right? And it is actually still increasing exponentially to this date. And it's from the developments that we see, it is relatively clear that it will continue to increase exponentially for the foreseeable future. So it is a good store of value. Now, personally, what I also find very interesting is the perspective that Bitcoin could provide more equal opportunity. Because right now, our monetary system and our banking system favors people who have good connections into these structures, because the closer you are to the source of money, to the central banks, the easier and the cheaper you get money, right? And then you can use that money to buy real assets. And therefore, the gap between the top 1% and all the others is widening. I think this is a very widely known social trend. And one reason of that happening is because we have the money system that we have, where just central banks control everything. And if you're an insider, then obviously you can profit from that. If you're an outsider, then you lose out. Yeah, you have the bottom 90%, and as you can see, it's dramatically decreasing the percentage of wealth that they possess. This is until 2016, so it's pretty safe to assume that, especially due to Corona, these percentages went even more extreme. So let's just say bottom 90% in the US own around 20% of assets, and top 1% owns 40%. So the top 1% owns double as much as the bottom 90%. That is social inequality. That is really, really bad for society, because if that gets too extreme, what you historically end up with is social unrest, even civil wars, or other wars with other countries, because you get political extremes. And this is exactly what we also see with Trump, right? If everything was fine, then Trump would never have been elected. So this is a very, very concerning development. And with Bitcoin, you actually don't have that, because there is no central bank who prints the money. There's only the network who issues money, and everyone has equal access to the network. Everyone can participate. So that's fundamentally different, and in my eyes, very positive. So as I promised, let's get into the network effect, so you understand why Bitcoin is actually worth anything, and why it is very likely to increase in value. And it is a real wonder, kind of, that this flywheel took off. Because once you have this dynamic, once it started, it is practically unstoppable. But to actually start this flywheel is extremely difficult. So let's start back in the days where you just had these cypherpunks and a few nerds adopting the Bitcoin protocol that was issued by Satoshi Nakamoto. And there was nothing to do with it. It was just digital bits, and you could literally not do anything with it. So the people, they just hoarded it. And they told, of course, others about it. And so others got interested and joined the network, and it grew bigger and bigger. And at some point, someone decided he maybe doesn't want to run the Bitcoin node and does the mining himself, but he just wants to be part of the network. So he started to buy tokens. Yeah. And this is where it started that Bitcoin got a price. That was very significant. So that's like the birth of the real birth of Bitcoin. Because then, because the network kind of grew and interest grew, Bitcoin rose in price. And the good thing is, with a rising price, that it creates media attention, right? And media attention, you know the saying, there is no bad press. Media attention always kind of is good for something that is prior was completely unknown. Obviously, it was not always positive media, but that didn't do much. And so it increased the perceived legitimacy of Bitcoin. Now, what higher prices also mean is that when you run a Bitcoin node, one of these mining nodes that actually seal these blocks, as I explained earlier in the blockchain, then the higher the price is, the higher your profitability is. So it suddenly makes sense for you to invest in more machines to mine more Bitcoin, because there is a market and you can actually sell these coins and you make a nice profit. So what that means is that you invest in machines, and that increases total hashing power. And the hashing power is basically the computational power of the network. So it increases the security of the network. And of course, increased security, again, adds to the perceived legitimacy of this network. Now, from there on, users and businesses get interested with increased legitimacy, and then businesses maybe start to, of course, only these entrepreneurial businesses in the beginning, they start to allow you to pay with Bitcoin, for example, or build a business on top of Bitcoin in one way or another. So businesses adopt this, and this already drives user adoption. So both, suddenly you have both drivers, the legitimacy and businesses that drive user adoption. So users go up, number of users go up, and that, of course, is a positive feedback loop in itself to businesses, right? So that's great. And then as a user, you see that Bitcoin actually has a use case. So in the beginning, of course, it was basically buying drugs on Silk Road. That was one of the first applications. But if you think about the internet, when the internet started, the first applications were practically exactly the same. It was pornography and drugs. So that seems to be the case with most new technology. So in any case, it developed since then, and nowadays you would be stupid if you use Bitcoin for illicit activities, because it can be traced quite easily, actually. So in any case, when you see a use in this, then you start to buy some. You start to buy some just for hoarding purposes, for later, basically, right? And then we are full circle back because hoarding increases the price. So this is how Bitcoin is actually accelerating itself. And now, since we have a market, since we have all of these kind of mechanics in place, it is practically unstoppable. So let's actually talk about the Bitcoin mining. And here, these are real pictures from Bitcoin mining facilities. So as you can see, it's no longer some people in the basement running Bitcoin on their laptop, but it is a multi-billion dollar business. And these are industrial grade facilities. So it's serious business, and huge investments as well. So how does the Bitcoin mining work? As I said, you get a block reward for sealing one of these blocks. And only one can always win this. So there's it's like a randomization game, and the more computing power you have, the more likely it is that you will win the lottery, so to speak, and actually get the block reward. Now, nowadays, there are so-called mining pools. That means, for example, if you, as a relatively small Bitcoin mining farm, you would only have the chance of, let's say, 0.01% to find a block before everyone else. So it makes sense that you pool your computing power together with others, so you have a more stable income, right? And you not win the lottery once in a while and then don't have anything left, and maybe wait for 2 years and just wasting energy. So yeah, it is for consistency purpose. But the key here is that the protocol is self-adjusted. So one of these data blocks is sealed every 10 minutes. And it doesn't matter how much computing power you put in. It is always 10 minutes because the protocol is self-adjusted. So if you have more computing power, then the difficulty of sealing one of these blocks is increasing. And if the network computing power goes down, then it is getting easier again. And that's very important, actually, because with this dynamic, you can ensure that the 21 million Bitcoins will be mined according to the plan, and not you just put in more energy and get the Bitcoins faster. That doesn't work. And as I said already, the rewards are halving every 4 years. So just in May this year, we had the most recent halving. So now we are sitting at 6.25 Bitcoins per block. So every 10 minutes, there will be issued 6.25 Bitcoin, which is around, what's that, like $70,000 or so every 10 minutes. And in 4 years, this will be halved again, right? Now, more hashing power means more security. It doesn't necessarily mean more energy cost, because because the mining business is so competitive that it pushes the boundaries of hardware research. So in Bitcoin mining, you have these so-called ASICs, application-specific integrated circuits, and these are basically little computers that only can do the mining or can only calculate the Bitcoin mining algorithm. But so they're kind of dumb. They cannot use any, or they don't have any mainstream purpose. But the result of this is that the hardware, like you try to get as many of these circuits in as close proximity as possible to increase the energy efficiency. And of course, this research and manufacturing skills, they can be translated into normal hardware, right? And so just like back in the days when computer games were actually pushing the hardware development of graphic cards, today you have Bitcoin mining pushing the hardware limits of application-specific integrated circuits. So that's very interesting and a very positive side effect, I would say. Now, if Bitcoin price increases, then the margins of these Bitcoin mining facilities increase. And then they would obviously spend more into hardware. So there's a constant demand, and more into electricity to mine Bitcoin, because it is simply economical, right? It makes sense. You get profit. So where are the misconceptions and misinformation that I was talking about? So this is an article from 2018, I believe. So the headline here on the right: in 2020, Bitcoin will consume more power than the world does today. Sounds pretty dramatic. Now we are almost at the end of 2020, and we are still not sitting in the dark. I would even argue that we have different problems than Bitcoin mining today. But this was obviously false, and this was predictably false. So I'm involved with this whole space since 2017. And I saw this coming. Like I was wondering, what are these people even writing? And this is not like anyone writing it. This was written for the World Economic Forum. So yeah, even those people get it wrong miserably. Either they get it wrong, or it was intentional misinformation. That's actually what I argue, because there are many interests in that time that would want to keep Bitcoin down, at least for a while, so they can position themselves. And that's exactly what happened. So right now, and maybe you even remember that JP Morgan, the CEO of JP Morgan, once called Bitcoin a scam and a fraud. Right now, just recently, JP Morgan announced that they issue crypto-related services, and that they issue their own coin, and also offer Bitcoin custody in the future. So it's a 180-degree turn, and it was actually because they were in fact investing into businesses in that space, but they were causing headlines like that. So always question when you find a headline that is not making or not coming up with clear reasoning, and as a sensational headline, because that's exactly what it is. So how about numbers, right? How can we say, or how could you see that this was wrong back then? This is the University of Cambridge. They have a very neat website. And as you can see here, Bitcoin, that was actually a screenshot from almost exactly a year ago, last November, where Bitcoin was using 71 terawatt hours of energy a year. And so it would rank somewhere between Colombia and Venezuela in terms of energy consumption. Now, this was 19, and as you saw in the last slide, they were even talking about that Bitcoin would consume in 2019, consume as much as the USA, which obviously didn't happen. And again, it didn't happen that we consume all of the world's energy today. The interesting thing is 71 terawatt hours per year, that was last year. Then we had the halving in between. And as as I predicted, the energy consumption went down. Right now, we're sitting at around 60 terawatt hours per year. So although the Bitcoin price is actually 50% higher than the same time last year, we use less energy. And this is very logical because if you think about it, the rewards get halved. That means your revenue is halved. And now many miners get unprofitable. So they have to switch off their machines. And that obviously reduces the energy consumption. But let's compare, because there's also this discussion going on, Bitcoin mining is a waste of energy, and we shouldn't do this and whatnot. But let's actually compare that, for example, to the financial system or the banking system. So this is the little article there. There was someone calculating or trying to estimate how much energy their banking system is consuming, and excluding the printing of bills and the minting of coins. He already calculated that the banking system would use approximately 100 terawatt hours per year. So that is already more than Bitcoin uses, and we're not complaining about that, right? Banking obviously is useful, so you don't say it's a waste of energy, so it's totally fine. But Bitcoin, as the potential base of a new alternative monetary system and an equal, really the possibility to have an equal financial system, is definitely at least worth that much. And then we also a nice comparison to the cost of mining of gold and of Bitcoin. This is very interesting because Bitcoin essentially, right now at least, has the same function as gold. It is a store of value, but it is a digital store of value. So it is even more practical than gold and has some advantages. The only disadvantage is that you cannot touch it basically, and that it is not that widely accepted or recognized as a store of value, but it is also continuously improving. So the development is pretty clear. And if we compare these costs, and in gold mining as well, most of the costs are concerned to energy in one way or another, then you see that gold consumes roughly 20 times as much energy as Bitcoin. And gold, you really don't use it for much, except for jewelry and as a store of value for monetary purposes. Except for that, it has some use in science and some specific applications like dental applications, but that's really, really small in comparison to the actual production of gold. So it's comparable. Good. So the key takeaways here from the Bitcoin mining is that the energy consumption is relatively low if you compare it to other uses of energy, and that it's definitely not a waste of energy. It even consumes less energy than the banking system. That's also quite interesting. And the energy consumption is dependent on the Bitcoin price and the block reward. So both determine your revenue, obviously. Now, because the Bitcoin block reward is cut in half every 4 years, in theory, you could double the price of Bitcoin every 4 years and keep the energy consumption stable, right? All else equal. So that's an exponential function. So let's say in 20 years, Bitcoin could have some significant value and some significant adoption, therefore, without even increasing the energy use. So if anyone wants to tell you, but you cannot have the transactions of all the world in Bitcoin because then the energy would be a problem, that's just complete BS. The energy is not the problem. The problem here would be that you actually cannot fit unlimited amounts of transaction into one block. So the transaction capacity of Bitcoin has an absolute cap as well. It's around, I believe, 200,000 transactions per day. You simply cannot do more. for technical reasons. But the energy is not the problem. All right, so let's look at the bright side of things from the Bitcoin mining, because there are actually opportunities and also solutions for maybe some shortcomings here. Because yes, it is kind of energy intensive, of course, yes. So it would be nice if there would be some positive sides, right? Now, electricity accounts for 60 to 80% of mining expenses, Bitcoin mining expenses. That means it is very important that you have cheap energy to be profitable in this business. Now, what is the cheapest energy? That's of course zero cost energy, right? And usually you don't have zero cost energy, but in terms of renewables, that actually happens, relatively often even, because you have these peak production times, and it is often not economical to store the energy because of the investment cost of the storage facilities, etc. But since Bitcoin mining is highly or has a very high part of variable costs, the sunk costs are not that high. So it could make sense. That's of course an individual calculation that one has to do, but it is already done. So I assume in many cases it works, that you install next to a renewable power plant, like a wind farm, you install a Bitcoin mining facility, and you just put it when you have too much energy, when you produce too much energy. And then you produce additional Bitcoin. Yeah? And that's really key, because that increases your profitability of this wind farm. And for investors, that's really nice, because suddenly they get a higher return on their investment. And then they are inclined to invest even more into renewable energy in the combination with Bitcoin mining. So that's a fascinating prospect, that you could even drive the renewable energy deployment by combining it with Bitcoin mining. So it's not all dark and gloomy here. Then another kind of solution in brackets is that Bitcoin just needs time to evolve. So here on the left side, you see a schematic representation of how technology and money is adopted usually. And this is basically has to do with the Lindy effect. The longer a technology is there or a money is used, the more you trust it that it will stay there. It is actually related to technology, but well, since Bitcoin is technology, it also applies. And as you can see, this is kind of also an exponential function, because the scale again is logarithmic, as you can see. But it slows down after some time. So it's not always going up like crazy. But as you can see, we are just at 11 years now, and it will take time. It will take a lot of time until Bitcoin is an established store of value and even a medium of exchange, let alone full global money. And as you can see, full global money, that's actually a conservative estimate, would be at $10 million per Bitcoin. That could be even higher. So we need a good amount of time. And during that time, the Bitcoin halving kicks in multiple times. So it's not that much of an energy problem. And then on the right side, I displayed some other cryptocurrencies. So there are a multitude of other cryptocurrencies for different purposes. And this is really important, because Bitcoin cannot do it all, and it should not do it all. Like technically, it is not suited to host like complex applications or so, in contrast, for example, to Ethereum on the right side. And these other coins are usually more energy efficient, because they don't use proof of work. So this Bitcoin mining is called proof of work, but they have different consensus algorithms basically consensus algorithms are the way that the blockchain or the network comes to an agreement of which blockchain is the correct blockchain. So they do it differently and way more energy efficient. And so they have their use case, but Bitcoin is still, it is good that Bitcoin exists because it is the most important and the biggest proof of work blockchain. And proof of work, you cannot just hijack proof of work. You would actually need to have more energy or more computing power than the rest of the Bitcoin network together to attack the Bitcoin network. And yeah, that's like really difficult. That's not feasible. So it's good that Bitcoin has this, or that we have one cryptocurrency, in this case Bitcoin, that actually has this algorithm. And especially if you think about the use case as a store of value, then you want to have it as secure as possible. And that's actually true with Bitcoin. All right, let's briefly touch use cases for other cryptocurrencies, because it is an exciting field and there are so many opportunities job-wise or business-wise. It's incredible. So one thing is decentralized finance, also called DeFi, which is mainly on Ethereum happening right now. And it replicates our financial system, but on a decentralized way. So you don't have a bank that you have to trust or where you have your account, but you have your own account. And you can, for example, get into contracts on a decentralized way. So completely permissionless, you can transact freely. Then you have the Internet of Things, the machine-to-machine economy. That's also quite exciting. So let's imagine, for example, you have Tesla already tinkering with AI in their cars, and it's going very well. There could be a future where your car is pretty much autonomous. So you, for example, would rent it out as a on-demand taxi, and then someone calls your car. Your car has a blockchain account. Then the car drives this guy somewhere. He pays directly to the car. Then the car, for example, notices, okay, I have some technical problems. I have to go to the workshop or get a recharge. And then it does that automatically. And because, for example, the workshop is also a machine, your car pays the workshop directly, and you don't have to manage anything because everything is managed by AI. Yeah, that's definitely thinkable. Then we have health data management. So you are in control of your personal data, which sits on the blockchain, and only you can access this data, and you can determine who else can access the data. So for example, if you go to a doctor, then you give him the right to read your data. You do that by cryptographical transactions, and you can also revoke that right again. So you have full control over your data, which is really different than today. And then next thing is digital identity. This goes also together, for example, with decentralized governance and voting. So you could prove on the blockchain that you are who you present you are by digital transactions, and you could use that for decentralized governance and voting, or even just enhancing the current voting system. So let's say, we have the US election coming up, and there's always a lot of drama about election fraud and all that. If you had a blockchain, a decentralized immutable blockchain, where you simply record the votes of every citizen, basically the citizen itself records the vote on the blockchain, combined with digital identity, so you don't have double or triple votes, then you could completely eliminate voting fraud. That's also a huge application. And you could even take this one step further, which is decentralized governance, and say, since everyone has internet, at least in the modern world, you could have more public involvement. So instead of just, the politicians deciding everything, there could be a political discussion going on, a public political discussion. And then there will be a date where all the citizens vote themselves for the different options. So that would be possible. That's really, I think that's fascinating. It really improves democracy. And for all of these things, there are already cryptocurrency projects that are working on this. So we have an exciting future ahead, I would say. The next thing is virtual assets, also called NFTs or non-fungible tokens. These are basically or these can represent virtual items. For example, if you play a computer game, then you could actually own the items or the characters or what you have there in the game. And you could trade it outside of the game for real money with other persons who would like to have that. So it enables a completely different virtual economy. And as we all know, the gaming industry is growing rapidly. So this is a huge market as well. Then we have distributed computing and data storage. Again, it kind of goes together with health data management. You could store your data in a decentralized way. You can already do that by using cloud computing. But in cloud computing, you have basically Microsoft, Amazon, and Google providing cloud services. And if they don't like you, in theory, they can just cut you off. And they can potentially even read your data. You don't know for sure if they do that or not. In this case, you could completely decentralize that, and no one has access to your data. And in terms of distributed computing, that's also a very, very exciting application, because let's imagine you are a hedge fund. So you have developed a very advanced artificial intelligence, and you have your proprietary data set, which is highly valuable. Detailed financial data is very, very valuable. So you don't want anyone to have access to both of these. But now you have the choice, because training an AI is quite expensive in terms of computing power. So now you could build your own data server farm, or you could just plug into a network of these distributed computing networks and have your data and your AI algorithm cryptographically masked. And so they could train your algorithm on your data without knowing what they are actually computing. So that's very fascinating. It's very complex. I think it's genius that this is even possible, but it is possible. So huge development here as well. And then last but not least, you have supply chain management. For me personally, well, not that exciting, but it is huge. Like you can track your complete supply chain on the blockchain. So you can trace everything from the place of inception or to the customer, or even after that, if you want, until the disposal, basically. And therefore gather new insights into how to manage supply chains and what your products are used for, etc. So that's also a huge field. And everything needs a public, distributed, decentralized blockchains, not private company-owned blockchains. That's very key. If you want to know more about Bitcoin and just read about this again in a condensed fashion, then I would recommend you to visit my website at knowingbitcoin.com. Just today translated into English, so everyone should have access to that. And now I would say thank you very much. We can stop the recording and go into questions and answers.